Trading is speculating on an underlying asset's market price movement without owning it. So, basically, trading means that you're only predicting whether a financial asset's price will rise or fall. You can trade hundreds of financial markets, including stocks, forex, commodities, indices, bonds, and more. We offer more than 13,000 CFD markets for you to speculate on. Think Meta shares, the US dollar against the British pound, crude oil, and the FTSE 100. When you trade, you'll use a platform like ours to access these markets and take a position on whether you think a market's price will rise or fall. If your prediction is correct, you'll make a profit. If incorrect, you'll incur a loss. The financial instruments you'll use to trade on an asset's price movements are known as derivatives. This simply means that the instrument's price is derived from the price of the underlying, like a company's share or an ounce of gold. As the price of the underlying asset changes, so does the value of the derivative. To understand this, let's look at an example of speculating on shares. If the price of a share goes up from $100 to $105, the value of the derivative will increase by the same amount. If you bought the derivative at $100, you could now sell it at $105. Although you never own the share itself, your profit or loss will mirror its price movements. So, why use a derivative? With derivatives trading, you can go long or short, meaning you can make a profit if that market's price rises or falls, as long as you predict it correctly. Contrarily, if the market moved against your speculation, you'd incur a loss. This is because trading isn't owning the actual financial asset. With owning something outright, such as gold for example, you'll only make a profit if the gold price climbs. Leverage can be another reason to trade with derivatives. Trading with leverage means that, instead of paying the total value of your trade up front, you'll put down a fraction of its value as a deposit. This is called margin. This means leverage can stretch your capital much further as you can open large positions for a smaller initial amount. With leverage, your total profits or losses are calculated based on the full position's value, not how much you paid to open that position. You can make far more than the initial margin amount you paid to trade, and you can also lose far more. This means leverage has built-in risk.